Welcome to the Pro Ticker Deep Dive.
Great to be here.
We've sifted through a ton of your input on the global market's sudden stop. Today, our mission really is to dive into what we're calling the Great AI Reckoning.
Yeah, it feels like a moment of clarity, doesn't it?
For 3 years, it was all about AI euphoria driving everything up,
Yeah.
relentlessly. But just recently, well, the market slammed on the brakes.
Hmm.
Suddenly, investors are being forced to look at valuations again. The actual numbers.
It really was a fascinating moment, that collective realization. The big headline shift hit on November 4th.
Right?
You saw the S&P 500 drop 1.2%, and the NASDAQ, it fell a pretty sharp 2%.
That was their worst day since, what, early October?
Yeah, almost a month, October 10th, to be precise.
And the context here is key for you, the listener. We weren't actually that far off record highs.
Not at all.
The S&P had just peaked, $6,890.88 on October 28th. So what we need to figure out is how that market psychology just snapped so quickly. 1 week, everything's priced for perfection. The next, you have Wall Street leaders suddenly getting, well, honest.
Yes, honest.
And boom, everyone starts digging into balance sheets again. What changed?
It's that sudden realization, isn't it, that the party, well, it can't just go on forever. We really need to unpack the fragility, the sort of structural weakness of the rally just before this drop.
Okay, let's do that. Let's unpack the setup. For most of 2025, the market felt like it was running on these, three unstoppable forces.
Right.
First, obviously, the AI hype machine. Every company was suddenly an AI company, or claimed to be.
Whether they were or not, yeah.
Second, this really deep-seated expectation that the Fed would just keep cutting rates, fueling those growth stocks.
And the third force, which, looking back, became maybe the most dangerous structurally, that massive concentration of capital.
Huge amounts of money, right?
Just pouring into a tiny handful of winners. The Magnificent Seven tech giants, they were doing all the heavy lifting for the entire market.
And that concentration, when you actually look at the data, that's what reveals the fragility. It was a disconnect. Should have been a screaming red warning sign.
Absolutely.
I mean, how does the S&P 500 hit an all-time high in October? Which it did when most of its own stocks are actually going down.
It sounds completely counterintuitive, but it was true. The number of S&P stocks declining, it actually outnumbered the ones advancing as we approached that peak.
Wow.
It was like the market was on life support, and only the oxygen machine, the 7 huge tech stocks, was keeping the numbers up.
And that weakness, that leakage, it was speeding up right before the drop, too. November 3rd, the day before the big fall. The overall index actually closed a little bit higher, but underneath. Over 300 stocks in the S&P 500 finished in the red.
So that tiny segment was masking the weakness everywhere else.
Exactly.
And look, we can't ignore the Fed's role in setting the stage here. They did cut rates, 0.25% in October. That brought the Fed funds rate down to 3.75% to 4.00%.
Felt dovish.
It did. And that signal basically gave the market permission to keep those high valuations going, especially for growth stocks, because their future earnings look better when rates are lower.
But the background noise, it was still full of warnings, wasn't it? Inflation was sticky, still around 3%.
Right, stubbornly high.
Which kind of suggested those hopes for more rate cuts might have been, well, a bit too optimistic.
Definitely overly optimistic, perhaps.
And if you looked at the VIX, our sort of nervousness gauge, what was that telling us?
Well, the VIX, the volatility index,
Yeah.
it was just lounging around, super comfortable, like 15 to 17, sometimes even lower.
Complacent.
Totally complacent. It suggests investors were basically pricing in zero significant risk, none at all. And usually when everyone agrees everything's fine, that's when the trouble kicks off.
And trouble kicked off because we ran smack into the core problem. This dangerous, totally unsustainable gap between valuation and reality. Investors were pricing AI companies like they had 20 years of guaranteed future growth baked in, ignoring that current earnings just couldn't justify those stock prices. Not even close.
The market needed a jolt. And the first big catalyst wasn't necessarily bad news, interestingly. It was more a sudden shift in tone from the big players.
The people running the major financial institutions.
Exactly. They just started admitting the obvious out loud.
Yeah, this part's really interesting. You had these high-profile CEOs, big Wall Street firms, publicly saying they expected a likely 10 to 20% drawdown, maybe in the next year or two.
And they didn't just say it, they framed it positively.
They called it healthy. When the people who usually benefit most from market stability start predicting a correction and calling it healthy, sentiment has fundamentally shifted.
That's a massive signal. It basically gave all the institutional investors permission, like, okay, you can de-risk now, it's fine.
Mhm.
And adding to that anxiety, we also heard warnings from a major bank chairman, specifically about systemic risks brewing in the private credit market.
Okay, private credit. That's often outside the main, heavily regulated banking system, isn't it? Why is a warning there so catalytic?
Exactly. Private credit has exploded in recent years. It often carries more risk than traditional bank loans, and it's murky, opaque, hard to track properly.
Right.
So a warning about instability there suggests risk that the Fed can't easily manage or maybe can't even see clearly. It just adds this unexpected layer of systemic fear on top of the already sky-high valuations.
And once that fear gets injected, you see that classic sell first, ask questions later's pattern emerge. Doesn't matter what the company actually reported.
Perfect example, Palantir.
Right.
They announced stronger than expected revenue. Should have been great news, right? A boost.
Instead, the stock tanked,
Yeah.
fell 8%.
It's textbook. The actual results, the fundamentals, they were solid. But the sentiment just completely overrode them. Investors looked at the earnings, then they looked at the stock price relative to those earnings and just collectively decided, nope, still too expensive. They sold based on that instant valuation judgment, not the quarterly report itself. Shows you the power of that psychological reversal.
Okay, so let's dig into the scope of the selling on November 4th. Because this wasn't just, a few tech giants shedding points. The breadth of the selling was really wide.
Oh, it was overwhelmingly bearish. On the New York Stock Exchange, declining stocks outnumbered advancers by 2.45 to 1.
Wow.
And the NASDAQ was even worse. That ratio was 3.16 to 1.
So for every stock going up on the NASDAQ, more than 3 were falling.
Pretty much. And think about this. On the NASDAQ, more than 260 stocks hit a new 52-week low on that one single day.
But, and this seems like a crucial distinction for listeners, the trading action suggests it was kind of surgical selling, not just indiscriminate panic.
It is crucial, yes. The tech sector got hit hardest, down 2.3%. That's precisely where the valuation worries were most extreme.
Makes sense.
But importantly, we saw gains in other sectors, financials, consumer staples, the more stable value type areas of the market.
Okay.
So this wasn't everyone just running for the exits, dumping everything for cash. It looked more like targeted de-risking, rotating money out of those perceived bubbles.
And this brings us back to that technical term you mentioned, the breadth gap, the extreme narrowness of the rally.
Yeah.
Why is that gap such a big warning sign for capital rotation?
Right, the breadth gap. It basically compares the regular S&P 500, the cap-weighted one that's skewed by giants like the Mag 7. It compares that to the equal-weighted S&P 500 where every company matters the same, regardless of its size.
So you see if it's just the big guys carrying the whole index.
Exactly. When the cap-weighted index dramatically outperforms the equal-weighted one, it means only a tiny, tiny slice of the market is actually driving the whole move up.
While everyone else is sort of treading water or sinking.
Precisely. And that gap right now, it's at its lowest, most extreme level since 2003.
2003.
Wow. And historically, whenever leadership gets that whisper thin, as they say, it signals a major capital rotation is probably coming.
Which means?
Usually, it involves a temporary setback for those giant leaders, and maybe a chance for the rest of the market to catch up. Or, in a scenario like this, maybe pull the giants down a bit.
Okay, so for technical context, let's be clear what this actually is right now. A correction technically is like a 10% to 20% drop.
Yeah.
Where are we actually sitting?
Good point. As of the latest data we have, the drawdown from that peak is only 1.37%.
Okay.
So technically, that's just defined as a pullback. It feels dramatic because it happened fast, but we are nowhere near official correction territory yet.
And the VIX, the fear gauge, it confirms that, right? It moved up a bit to around 17.19, but not explosively.
Correct. 17 definitely shows some nervousness, maybe some necessary reassessment happening, but it's far from panic levels.
Right.
Systemic panic, where people are just liquidating everything. That usually sees the VIX spike above 25, maybe even higher.
So this feels more like a healthy adjustment.
That's how it looks for now. A healthy nervous adjustment, perhaps? A required self-correction by the market, not necessarily a signal of imminent economic collapse.
Okay, so let's look ahead then. Given all this uncertainty, what's the bull case? Why might this just be a healthy, temporary thing that sets us up for new highs later?
Well, the strongest argument for the bulls really hinges on earnings. Actual corporate earnings growth is still fundamentally pretty solid,
Okay.
particularly for companies that are actually succeeding in turning their AI investments into real measurable revenue. We're still pretty early in seeing productivity gains hit the bottom line, and those potential gains could provide a floor for the market.
And technically, the underlying long-term trend still looks strong.
It does. Look at the S&P 500. It went 129 consecutive trading days without even touching its 50-day moving average.
That's a long streak.
It's the longest streak like that since 2007. That confirms the underlying trend is still bullish, despite this recent hiccup.
Thus, seasonality.
And we shouldn't just dismiss seasonality, no. November has historically been the best month for stocks. The S&P averages like 1.9% gains in November.
So if this pullback finds its footing quickly,
That seasonal tailwind could provide just the momentum needed to calm nerves and start pushing back towards those recent peaks. It's possible.
yeah, that sounds reasonably reassuring. But now we absolutely have to turn to the bear case, the real risks that justify those CEO warnings and that dramatic selling. What are the structural reasons this could actually get much worse?
Okay, bear case. We have to come back to that AI return gap. This is really the core of the argument. We've seen some compelling research, like that MIT study.
Right.
It found a staggering 95% of organizations that rolled out AI initiatives generated zero return on investment.
95%, zero ROI. That's bleak.
It's huge. The money's being poured in, but for most companies, the promised productivity just isn't showing up yet.
And compounding that is this idea of work slop.
Yeah, work slop. It's the term researchers are using for all this AI-generated content reports, code, data analysis that looks productive, it fills up space.
But lacks real substance.
Exactly. High volume, low actual value. It means all that massive capital going into AI isn't necessarily translating into proportional, useful business improvement.
And the cost of just keeping this AI infrastructure running, it's eye-watering, right?
It really is. We're talking massive upfront spending on hardware, data centers, plus rising operating costs for energy and talent.
Mm-hmm.
Some estimates suggest AI companies might need something like $2 trillion in combined annual revenue by 2030 just to fund the necessary data centers and operations.
$2 trillion just to break even, essentially.
Just to fund the infrastructure. That cost is a major barrier, and it fuels intense competition.
And that competition is fierce. It could easily undermine pricing power, couldn't it?
Absolutely. The threat of someone else releasing a cheaper, maybe more efficient AI model, like what happened back in January 2025, that can just fundamentally change the profit outlook overnight. That single event reportedly caused the NASDAQ to drop 17% in one day.
Wow. Just shows how quickly valuations can evaporate in this space.
Exactly. Fragile.
Then you layer on top of all that the macro headwinds, stuff totally separate from AI performance.
Yeah.
We just had that record 36-day U.S. government shutdown. Stopped crucial data releases.
Yeah, breeds uncertainty. When you can't get the official data, you're kind of flying blind.
And what we do know isn't exactly great.
Not really. The ISM Manufacturing Index for October, still indicating contraction, below 50 at 48.7. Unemployment is ticking up slowly. These are signs of deceleration. They kind of contradict the market's earlier optimism.
And we still have those nagging trade tensions, protectionist policies bubbling up.
Which is another major headwind, yeah. Protectionism often means higher input costs for businesses. That risks pushing inflation back up again.
And if inflation proves stickier than the Fed hopes,
they might be forced to keep rates higher for longer than the market expects. That's a significant drag, especially for those high-growth tech valuations that rely on low rates.
So, okay, if the bear case really takes hold, if we move beyond just a pullback, what's the kind of technical downside we should be bracing for?
If we actually fall into that 10% to 20% true technical correction zone, we could see the S&P 500 drop to somewhere between, say, 6,200 and 6,400.
And that 6,200 to 6,400 range, that's pretty much exactly what those CEOs were calling likely over the next year or two.
It is. It shows you the potential risk out there if this shift in sentiment really sticks and deepens.
Okay, so wrapping this up, what does this all mean for you, the listener? The key takeaway from this deep dive seems to be that the market's sudden stop is mainly about these structural issues converging.
Right. Extreme valuation excess meeting dangerously narrow leadership.
It is, first and foremost, a market event right now, not yet a confirmed full-blown economic collapse.
And that presents an opportunity, really. If you were heavily concentrated in just those few mega cap tech stocks, this is your wake-up call. a chance to reassess that risk.
Right.
This correction or pullback, it's allowing some quality companies, ones that got overlooked during all the hype, to potentially be bought at much better valuations. It forces some pragmatism back into investing.
So this pullback is teaching a maybe harsh but necessary short-term lesson about fundamentals mattering again. But the big question remains. What's the next real inflection point for the overall trend?
That's the key question now. Will the technical selling just keep going? Will momentum push this pullback past that critical 5% or maybe 7% level from the peak? Or will the real trigger for the next major move be actual confirmed evidence of sustained broad economic weakness? Things like, employment really starting to deteriorate faster, or consumers genuinely slamming their wallets shut.
Yeah, that's the factor that decides if this stays a healthy nervous adjustment.
Or turns into a much more serious correction. That's what we all need to watch very closely next.
See you all in the next Pro Ticker Deep Dive.